This accounting mini lecture examines inventory costing using the LIFO method. Now, as we can see in this chart, while the majority of companies do use the FIFO approach, there's still a significant portion of companies that do use the LIFO costing method. Now, as we discussed in previous presentations, remember that the inventory costing approach is only focused on cost flow. Okay, it does not necessarily reflect the physical flow of the goods. So just because we use the LIFO method for inventory costing doesn't mean that that's actually the way that our goods are going to physically flow. We are still probably going to sell the oldest goods first in most cases, okay? But it just means that when we are matching our cost against the revenues on the income statement, we are assuming that the last cost accumulated are going to be the first cost that we apply against those revenues. And we're going to look at an example. Okay. Again, for the purposes of this presentation, we are focused on last in, first out, which is abbreviated LIFO. It assumes cost flow in the reverse order incurred, which again is just last in, first out. Here we are going to look at the same example that we used in the FIFO presentation, okay? So we have our beginning inventory. We have a purchase that occurs on August 3rd. We then have a sale that occurs on August 14th. We make a couple of additional purchases, and then we make a final sale on August 31st. So let's examine how these costs are going to flow. Again, remember we're using LIFO. That means the most recent costs are going to be moved into cost of goods sold, while the oldest costs are going to remain in ending inventory on the balance sheet. Okay? So again, this is similar to what we saw in the other presentation, except this time we're using LIFO instead of FIFO, okay? So we began with an inventory balance of 10 units. That is our first inventory bucket. That is the beginning inventory bucket. We then purchase a second bucket of inventory here, 15 units at $106. So when August 14th rolls around and we need to sell 20 units, what we're going to do is we're going to use the most recent purchase. That's going to be the first thing that we assign to cost of goods sold. So we are going to take 15 units, all 15 units from the August 3rd purchase at $106. Then we're going to, because we still need 5 additional units, then we're going to dip into that first bucket of inventory and pull out 5 of them at $91. That gives us the 20 that we need to sell to our customers. Okay. Then again, we're going to make additional purchases here on the 17th and the 28th. These are going to be separate buckets of inventory that we're going to carry. Now, let's look at what happens when we need to sell 23 units on August 31st. Again, we are going to dip into the most recently purchased buckets first. That means we're going to first pull out the 10 units at $119. At that point, we need 13 additional units because the customer wanted 23 units. So to get those 13 units, we're going to dip into the next most recent bucket because we've used all of these, the 10 at $119. So now we're going to dip into this bucket and we're going to pull out 13 at $115. These are the costs that are going into cost of goods sold. All of the older units are going to remain in ending inventory. And we can see here that using this approach, our total cost of goods sold is $4,730, while our ending inventory balance is $1,260. Now, let's look at how this compares when we look at the income statement and balance sheet impact. When we use the LIFO, remember we assigned cost of goods sold of $45.70. Now we're at $47.30. So when we look at the difference in net income, we can see that FIFO actually yielded a higher net income compared with LIFO because we were using higher cost under LIFO. Meanwhile, under FIFO, we also see a larger ending inventory balance compared with LIFO, which shows us a smaller ending inventory balance on the balance sheet. Thank you for watching this video on inventory costing using the LIFO method.